Good morning. My name is Ann Cucci. I'm from Township of Parsippany. Welcome to Understanding Your Audit Report. This workshop will review the annual audit report that includes financial statements and the related notes to financials. Our speakers for this workshop include Mon Lee and Valerie Dolan. Mon Lee is a principal with Nisivoccia and a licensed CPA, PSA, and RMA. Ms. Lee is also a member of the American Institute of Certified Public Accountants and the New Jersey Society of Certified Public Accountants. Valerie Dolan is a partner with Nisivoccia and is the licensed CPA, PSA, and RMA. In addition to being a member of several professional associations, Ms. Dolan specializes in audit services for public entities. I would like to thank our speakers for being here today, and please make sure to scan your badge for your CEU credits. Thank you very much.
As Ann had said, our topic's a little on the drier side as it's your audit, but it was one of the topics that we felt would be important information for you all to actually be aware of. As you get your audit report once a year, and it's really important to know all of the data that's actually included in your report and all of the information that goes in. One of the things that we wanted to start on is really going over, first of all, really what's in an audit. There's different types of opinions that each of you can be rendered on your audit. In addition, there are notes to your financial statements. And then we also have the notes, your schedules of assistance, which is your documentation of all of your grants. And then in addition, we wanted to go over a couple of common findings and issues that we see throughout as we're going around doing our audit work. And then lastly, we wanted to cover if there were any kind of questions that anybody might have on their report. Most people are aware of what an audit, that they have an audit done, but most people don't really understand exactly what's involved in an audit. Our audit is not a forensic audit. We aren't looking for things that might be wrong. We're really more of involved in an audit of looking at whether the financial statements are materially presented. They're not misstated in any way, but we do not look at every transaction. We do a sampling, and there is a lot of misconception in that we select samples based on our judgment, areas that we feel are areas that we should be covering, in addition to covering all of the things that are required under a regulatory basis. So a lot of times people think that we look at everything, and we really don't. So we accomplish our goals for an audit really by looking at and assessing the controls of each individual township. Each town operates differently. So each time we assess something, we need to look at them differently and assess where we feel is the areas of your risk. And then once we've decided where the areas of risk are, we then devise an audit program to test them to make sure that things are going thoroughly in the way that they're done. And then once we assess those risks, we then look at the tests and we design our tests to look at. Historically, I'm sure as you go through your audit process, you see the same questions being asked by your auditors. You see they ask for the same similar information, but every once in a while they probably throw something in that's new. That's usually their auditor judgment saying, you know what, I'm going to look at this year. I'm going to rotate, I'm going to look at this year. One of the things we don't look at, which a lot of people are misconception is we don't do an efficiency. We don't look at your office, anybody's offices in any town hall and say, can you operate more efficiently if you did something differently? We don't look at an efficiency side.
Yeah, one of the examples that we like to tell people when we explain what the difference between what we do for an audit and what we don't do for an audit is, if we select a phone bill, for example, we just test to make sure that the phone bill is properly approved by your governing body, by all your department heads. We don't look at the details of the phone to see, okay, each phone call is made to a legitimate municipality-related operation. So that's a common example that we we try to explain.
One of the other areas when we did ask that when we were looking at topics is the area of actually your opinion. Most people don't realize that in the front of your report is an actual opinion that your auditor is attached to that opinion. There are several different types of opinions that can be covered in that audit report. And we kind of wanted to let everyone know what those differences are so that when you're reading your own opinion, you know what type of information you're getting in your own report. Because most people we find when they look at that, they don't realize what type of opinion is being rendered on your own financial statements. Everybody historically flips to the back of the book to see what kind of comments and recommendations they have in the report, but they don't actually look at the opinion to see.
we're required to issue an opinion if the financial statements are prepared in accordance with GAAP, generally accepted accounting principles in the United States. And on the most part, unless you're part of the original pilot that the state started back in, I don't know how many years ago, that you're preparing a CAFR, the opinion on the GAAP basis of accounting will be adverse because for most municipalities and counties prepare their financial statements on a regulatory-based accounting in accordance with New Jersey accounting rules. So like I said, under GAAP, it will be adverse. That's the most common opinion we'll issue. And for the regulatory-based accounting, it's either modified or unmodified. When we modify a report, it's usually something, one of the common reasons would be qualification for fixed assets, which we're going to talk about a little bit later. And we also issue an opinion on whether the financial statements are materially stated or not.
So we kind of went through when we looked at, so just so you're aware of what type of opinion you're looking at, when you're looking at, you have an unmodified, if you have an unmodified opinion, basically it's saying that everything is included in your report and your financial statements are presented fairly in all material respects. When you start going into a qualified opinion, usually there is a qualification and it's usually for a specific reason. Doesn't mean the whole financial statements as a whole are given, it's usually for an elimination of some item. Usually that means that we're able to, usually what comes up is we're unable to obtain a complete audit information on one audit procedure, which would lead most auditors to give you a qualified opinion, and it would state why it's qualified. One of the areas, like Ann had said, was in the area of fixed assets. Fixed assets is an area that a lot of qualifications do exist, in that the fixed asset statute requires you to track your fixed assets at historical or reasonably historical cost. It's not really an easy thing for most municipalities to come up with a historical cost for your land, as most of it was either given to you or deeded. So a lot of times we don't have that value, and that value is not included in the report. Therefore, the auditor might take the approach to qualify the opinion for not including fixed assets in that information.
Just out of curiosity, who here prepares the financial statement with GAAP? That they prepare a CAFR? I'm just curious.
Yeah, there's a few of you in the pilot program.
Okay.
So we thought there weren't that many, so we sort of figured everyone was going on the other method. And then there are two other types of audit opinions. You don't usually see them in a municipality. There are areas of adverse and a disclaimer when there's real issues. Those are really left for areas that have a lot of issues. Most of the time you don't see them in a municipality unless there's a major problem going on, and at that point the opinion's probably already long since known and discussed with you. The other area we wanted to cover, which we felt was very important, was the area of your notes to the financial statements. Everybody's so used to looking at your actual financial numbers, but there is a lot of information included in the actual middle of the report, which is your notes to your financial statements. So we wanted to touch on each of the areas that we felt were areas that you should be aware of, and by all means, you should be reading through them on your own audit to make sure that they're covering really what's really happening in your municipality. Some of that stuff doesn't change from year to year, but if it's stated incorrectly and someone was to look at it, it's very good to know what's going on.
So the first notes that you typically see would be a summary of significant accounting policies, and it's going to have a description of the entity, your municipality, your county, whether your fire districts or libraries, description of all the major funds, which include your current fund, capital, trust, utilities, and also a description of the basis of accounting. The basis of accounting has a description of when you're supposed to recognize revenue and when you're recognizing expenditures. So typically for a municipality, revenue is recognized when it's received in cash, and grant revenue is realized in the operating funds when it's budgeted, and in the capital funds when improvements are authorized. In terms of expenditures, they are recognized as soon as the budget is adopted.
Another note that's in your report is your long-term debt. Your long-term debt actually has a lot of information about the debt and it's really a summary of your annual debt statement. It includes a summary of all of your debt issued, all of the debt that's authorized. It gives you your calculation of your net debt. It also gives you your calculation of your borrowing power. Sometimes I don't know if necessarily everyone's aware that that information is included in your report. When it comes to utilities, there's a calculation for your self-liquidating on your utility, and included in there is a debt schedule. It shows back all of your paybacks of all your debt information. It will give you the next 5 years in detail, plus then it will summarize each of the 5 subsequent years after that. And it also includes any other debt that is outstanding other than just bonds, notes. There's also a piece that's now included in your reports, which is your net pension liability. That number is also included in that information, and so suddenly all of the debt that you have, and then you have this large pension liability that's now in a municipality, is only recorded in the footnotes. In other audits, there are included actually on their balance sheet, but in a municipality, it is in your footnotes only, so that's the only place you'll be able to see that information on pension.
One of the newer notes that we have that's been expanded in the past couple of years is the pension plans. Description of PRS, PFRS, DCRP, and under GASB 68 and now 75, the notes used to be a page long, a couple pages long. Now it's 15 pages long. And people aren't aware, GASB 75 is effective for this year end, this, June 30th, 18, and December 31st, 18.
Yeah.
And right now we're in the midst of performing all our school board audits, and we have heard from the state that we're not going to get any of the GASB 75 information until mid-November, if not later. So that pushed us all back for all of our school board audits, and we can't issue them until basically December.
So we're hoping that that information is actually available by your year end of December, so as we're issuing our municipal audits, we'll actually have that data to also include.
Yep. So for GASB 75, it's it's other post-retirement benefits. And if members of your municipality, your employees, are enrolled in any of the PRS, PFRS pension plans, and within the pension plan, there is other post-retirement benefits other than health benefits provided to retirees, then you are subjected to GASB 75 and will have to disclose various types of information in a note, which include a detailed description of each of these plans, the benefits provided, all the required contributions, pension liabilities and expense, and various other information that is required by the standard. And it also disclosed only in the footnotes what the potential pension liability would be. And unlike on a GAAP base of accounting, you don't record that on the face of your financial statements, which can be a huge, huge number.
Another footnote that's in that information is obviously selected tax information. We have all kinds of information about the taxes. You have your tax rates, you have assessed values. We have a nice little joke, because I think that's pretty much sums New Jersey tax. When you start to look at the tax bills, most people do panic about our tax bills. But it gives you a lot of information. Your percentage collection rate is in there. There's all kinds of, on your tax levies and your percentages that give you your assessed values. It breaks down, it'll give you the information on your school tax, your local tax, so that when you're looking at those numbers, you can really see what breaks up that tax rate that's included in your information. Another information is your cash and cash equivalents. That really does describe, that's another longer note, and it gives you a lot of information about your actual cash. It gives you a listing of all the types of investments that a municipality can actually invest their money in. It gives you a description of your cash management plan, which is one of the areas that as you're changing your cash management plan and modifying it, we should make sure that the footnotes include that change in your cash management plan. It gives you a summary of all of your balances of cash, where they're being held. It tells you by fund what's in each of the funds that are included, and it gives you a summary of all of your investments. If you have any type of investments, it gives you a detail of all of your investments.
Another note in the financials is risk management. So this covers the various insurance coverages, the town have, whether it's property insurance, auto insurance, health benefits, or prescription. And if you're part of a joint insurance fund, it also have a description of the insurance fund and some of the coverage information, and also the year-end financial information, which can be helpful in assessing whether you're going to have additional contribution that you will need to plan for.
And then one of the things that is important that I think gets kind of buried in this footnote is if you are a member of a joint insurance fund, it actually gives you the income statement and a balance sheet of how your insurance fund is doing. So you'll be able to see their most recent set of financials in your own financials. It documents your insurance fund's assets. It documents all of their fund balance, what type of dividends they've paid out. I mean, that's important information on your joint insurance fund, and all of that's included. It's usually the year behind because obviously their year ends are the same as yours. So we don't usually have that final information, so we're always a year behind. But it's really important, and there are things about those insurance funds that are disclosed that if in fact the fund was to have a problem, you can be assessed additional assessments can be put on those onto the municipality. All that information is detailed in there, so to make sure that you really understand the insurance fund that you're involved in. And it also gives you who the persons and the contact people are for those insurance funds. So if you have any questions, you know who to reach out to, where that information is included.
The risk management note also has a section with a description of your unemployment compensation insurance plan, whether your municipality follows the reimbursement basis or the contributory basis. And the only difference is that if you are in the reimbursement basis, you keep the money in a trust account and you pay the state as you're going along and you get additional bills, versus the contributory, you're sending all the money to the state ahead of time. And it's going to have a little summary recap of the activities in the trust account, typically 3 years.
And it's always a good number to look at because then you can see what kind of money are you running in your unemployment account. Are you covering your own costs in there? And if you have to raise additional monies, or if there's money sitting over there that you need to use, then you understand that money gives you in a little table format.
Contingent liabilities, and this is part of the reason why we usually ask you to send out a legal request letter. We need to get from your attorney a list of any pending litigation that can potentially have a significant liability that you have to account for on your balance sheet, and which includes tax appeals, which, as some of you might know, can be a huge number.
And we have to make sure on that tax appeal number, not only do you have a reserve, you have a reserve set up for that pending tax appeal, we go one step further and we look at it and we reach out to your tax collector and your assessor and say, is that reserve established enough to cover pending appeals? And if it's, or is it overly is there over too much in that reserve? We do look at that number to make sure that if there's any type of large liability like a pending tax appeal that could really impact a municipality, are you preparing for those appeals? And would you be covered if in fact you had a large appeal? Several years ago, we had a lot of towns that did not have these reserves and they ended up having to borrow debt to pay back on those tax appeals. So we've started to really pay attention to those appeals to make sure.
And we typically try to talk to your tax assessor too and get a listing of all the significant tax appeals and do an assessment on whether your reserve is built up enough or not, or if you do need to establish a reserve. And GASB 75, I had talked about before, so I'm not going to go too much into detail about it now.
Right, and then the one area that we wanted to also cover was area of fixed assets. This is one that we sort of told you in the beginning. Sometimes not everybody has that information. There is a footnote in the fixed assets if you have audited fixed assets. They're included in your notes, your financials. But your fixed assets need to be recorded, which is the key part of the statute, at historical or an estimated historical value. Not at an assessed value, not at an insured value, not at the replacement value, but it's a historical value, which is a hard number to come up with, especially when you don't have one if you didn't have a fixed asset appraisal report done. There are vendors out there that will come in and do an evaluation. You can maintain these records in-house also. It's just a matter to always remember it's really historical, which is the harder part. There have been coming in a lot of, this year seems to be a division's focus on their desk reviews on whether your including fixed assets in your reports? Are you including them, and are they audited? The division is really looking at them this year to make sure that all of those municipalities are including them. So if you're not, or you're not sure, I would check with your own audit and see if in fact you don't have them. And if you don't have them, the division will be looking to try and get everyone to rectify that situation so that you can make sure that you get an appraisal done that gives your auditor information to audit from. A lot of auditing firms did not include them in your reports because historical wasn't a number that you had, and we just chose not to pursue it, and we've taken a change in the opinion, which now the division is coming down saying they want you to have the information in your report.
It's one of those things like with our school audit, we have to incorporate fixed assets into the district-wide financial statements that at the end of the day, not a lot of people really care about, but obviously it's one of those things that the division now is focusing on, so.
Now comes the bigger, newer one of last year, as this was required to become effective in your 16 audits, which is tax abatements. These are all of your pilot programs, as everyone is doing, and there is a lengthy disclosure that's required on those agreements. So it requires you to disclose tax abatement information about any kind of abatement that you might have in your footnotes. In addition, that if there's any entered into by any other governments that are reducing your tax liability for any reason. It requires them to disclose all of the key information about those tax pilot programs, any kind of information that has not been consistently or was never really disclosed in previous years. I mean, there might be agreements that are out there that your municipality might have had for the last 10 years, and more than likely that information is not included in your report. As of 16, it was required to be added to your report, so you might have found that your auditors were asking you to dig out some old agreements, dig out some old ones, or if in fact you don't realize, you look at your own report and don't see it included in your report and you know you have some agreements, make sure you discuss it with your auditors so that that information can be disclosed properly on those agreements as the plan is required now.
Yes, as Valerie has said, it's hard for us to get a lot of the old information, old agreements, and some of them can go back to 1960-something, 1970-something, especially a lot of that I've seen with housing authorities within your town. And also, even tougher is on the county end, because under the standard, you're supposed to also disclose these pilot agreements or tax abatement agreements that's been entered by other government, meaning your local municipalities, that can affect your county revenue, your tax revenues. So trying to get a list of that we found was kind of impossible because the county tax board really don't keep a track of those pilot agreements.
That was a difficult one, and that's why when it did come in, we really relied a lot heavily on our own municipal clients to help us find that information and track that information down because it was lengthy and difficult to ascertain.
Another common one, other than just the normal pilot agreement, would be a lot of those redevelopment that's been going on now. They have within those redevelopment agreement a type of tax abatement in there, so you have to also disclose those type of agreements too.
So that's really, then the other area that we really wanted to cover was really in the area of your schedules of assistance. There's also another set of footnotes that I'm not sure everyone's aware of in your notes to the schedules, which are in the notes to the schedules of assistance. There is, those disclose information based on your schedules of assistance of your federal and state awards. Those two schedules in your report detail all of your grant agreements. They detail all of your grant expenses. It goes through all of the aids that you receive. But in that notes to the schedules, they disclose not only the basis of presentation, which is under what we refer to as the uniform guidance, which is just under what we report those single audit recommendations in single audit areas, and it discloses the policies and procedures followed for your grant funds. Not everybody allocates, has a true grant fund accounting. We've seen many municipalities that sort of keep their grant funds within their operating funds, and we're required to once again split them back out again, so we have to disclose on how the accounting is handled for those grants. Also, if you have any type of loan agreements, your loan agreements are also included in there. any NJEIT loans or any of that information. We disclose all of those loan agreements in that section of your report in addition.
Yeah, and under the uniform guidance, they have a list of requirements as to what sort of information has to be disclosed on your schedule of expenditures, including the granting agency, the CFDA number. Now, with under the new uniform guidance, they're also requiring if you provide any money to subrecipients under the grants, it has to be disclosed either in the footnotes or on the face of the schedule. So it's a lot more information.
Comes a lot with a lot of the counties when you're doing the county financials, because they provide a lot of subrecipient information out. It becomes very voluminous. These schedules and these notes can be very lengthy in that there's a lot of grant money that's moving through the state, through the counties, and out to each municipality. So a lot of places you are the subrecipient. All right. One of the other areas that we did want to cover, which becomes more prevalent as most people get to that section of your report that everyone really does focus on, is your comments and your recommendations, some deficiencies that we see. So we wanted to cover some common, what they refer to as findings, which are in your audit report. There are two sections, if you're not familiar, if you're looking at your audit report. There's a section called your findings of question costs, and then there's an actual section called your comments and recommendations. An auditor can put comments and recommendations in both sections. The difference between the two sections would be anything in your back section or the last page of your report, which is your comments and your recommendations. They're the items that are more of housekeeping. They're not material. They don't affect your financial statements. If in fact there's something that we feel is a weakness that could impact your financial statements as a whole, we would report them in your schedule of findings and question costs. One of those common areas is segregation of duties, and small municipalities just don't have the manpower to actually have enough segregation of duties. By all means, every municipality has what we refer to as a compensating control, where they have a way of knowing that things are being a series of checks and balances. But in the accounting world, no matter how many checks and balances you put in place, the fact that you might have the same person receiving and expending funds and posting in the ledger and reconciling the funds, you have a segregation issue because there is an area that it's potential that there could be some sort of misstatement. So a lot of times you see in reports of what we refer to as you'll find that area in the comments, not just in the comments and recommendations, but you'll also see it in our finding in that it's potential. Doesn't mean there's an issue. We just identify the potential of an issue so that people are aware. And it's usually addressed based on size and based on the management's aware of it, but they're not going to turn around and go and hire 1 million people in a municipality just so that the audit can not have that comment in there. We feel that usually it's better just to make sure that you're aware of the situation.
We get asked, how do you resolve a segregation of duties problem? Because that's most common in an area, like Val said. If each of the department collects the cash and issues a permit and keeps the ledger for the permits and the cash, then how do you get away with it? The only thing you can do is implement a central cashier, which involves hiring additional people and involves inconveniencing your residents because they're going to have to go to your department, get a slip, go to the cashier, pay, go back to the department, show them the slip that you paid, and then issue the permit, which is a lot of hassle, and not a lot of people want to do that. We only have a handful of our clients that do have a central cashier.
Yeah, you'd be surprised. It's really not obviously a procedure that most municipalities have in place, nor is it a cost-effective process just to, like I said, just to make the audit not have a comment. At the end of the day, is it really worth the cost of a municipality? I'm sure you all can find a better place to spend money in a municipality than to try to eliminate a segregation of duties issue. One of the other areas that is also in this section is when there are the accounting directives. There are the 3 accounting directives. You maintain a general ledger, you have fixed asset accounting and reporting system, and you have an encumbrance system. Those are your technical accounting directives. If in fact you're not in compliance with any of those technical accounting directives, we would also put a comment in the comments and the findings and question costs area because you're in violation of a directive. So usually we see that one for, and that's where you'd also see fixed assets. There was a handful, we have a municipality that doesn't have an encumbrance system. They also have a comment about they're not having an encumbrance system. But for the most part, for a while, a lot of people didn't always have a general ledger. That now has been rectified. Most municipalities now have a general ledger system, so therefore that one is now no longer, you're in compliance with that directive. So we just try to make sure that we look at those directives in addition to just our normal audit procedures. And then all of that information, like I said, will be disclosed in the comments on the disclosure and your findings and question costs. And in that area, you will be required to put in what we refer to as a management's response. You'll have to address on what you want to say and what you want to do. And that if money suddenly comes up and we suddenly decide we're going to hire somebody, but budget constraints most times is really the response. Budget constraint allows us to not address this time. We'll reevaluate it if the budget changes again. So.
And on the schedule of findings and question costs, other than these common examples that Val had mentioned, if you did have or do have a federal single audit where you spent over $750,000 on either federal money or state money, and when you audit that grant, and if your auditor has findings, then those findings go into the section 2, and it gets reported to the federal government through the federal clearinghouse.
And then one other area that we did want to cover is the area of trust reserves. You do have some ability to set aside some money in some trust reserves, which give you balances to cover certain things. We have trust reserves that are available, obviously, for storm recovery. At one point, that was your snow money that's now become storm recovery, because as the weather keeps changing, we no longer just have snowstorms to consider with. We want to make sure that we would look at a municipality, make sure that you have have you used these reserves? Have you set up some money for these reserves? We would also bring in, we would have that discussion, do you feel that you have enough reserves, or would you like to set up more? How would you go about doing that? Another one that we have is you have the ability to have a reserve for your compensated absences. As you know what your liability, which is disclosed in your footnotes, you can have the ability to set aside some money to pay those compensated absences if you need to, instead of having to run it straight through the budget in the current year in which, because as a lot of municipalities, I know this has changed over time as people have gotten kind of control of their balances on a go-forward basis. In the past, there was lengthy and large reserves for people who have been long employees, people who have it in their contracts. This compensated absences balance can be a large for a municipality, and it's not something you might be able to just fund out of your budget in a normal year. We recommend putting in a reserve for that. There's also a self-insurance deductible reserve that we've seen come up in some of our municipalities, where if you're in a self-insurance or you're in an insurance fund, there are deductibilities that are associated with your insurance plans. We've seen reserves coming on the balance sheet now for those types of things, for those types of reserves, so that if you have to pay a large deductible on an insurance claim, you have that money set aside. If there's any other reserves, sometimes the one piece that we do have when it gets into the trust side is, as everybody knows, once you get money onto your trust reserve, you need a dedication by rider to spend the funds. So not only when you establish these reserves and set them up, make sure that there's a dedication by rider approved, because you want to be able to spend the money in time. As you're accumulating the reserve, you don't, but to actually expend those funds, you need a dedication by rider, which the division you have to apply for on the division side. Some of these reserves that we've named, they do approve them, so you just have to make sure that you have them. And we suggest that you go through all of your trust reserves and make sure every one of your trust balance sheets has a dedication by rider, so that when you're authorizing, because you don't want to come up with a problem where you're spending money out of a trust fund that you don't have a dedication by rider on, as that will end up being a comment and recommendation in your report that you're spending without an authority under the trusts. We covered a lot of information on your notes, but we definitely wanted to leave some time for some questions, because not everybody has the same type of information going on in their municipality. We tried to cover common areas, but I'm sure there are some questions that people might have on their financials. One of the things that have come up in our conversations as we were talking to a couple CFOs and stuff last night was, how many people actually prepare their own financials or prepare their own footnotes? Most times you give us the information and the auditor themselves puts together the information. And as a result, not everybody really sees all of that information that's going in. So I'm just curious, is there a lot of municipalities who are preparing their own financials, or are you leaving it? I mean, everyone is working on, but in reality, our audit really is an audit of your financials. So when we try to encourage people to start putting forth some effort and to put that information together so that we can audit them and tell you how you should be able to prepare your financials, or at least some summary information that assists the auditor in preparing them. The footnotes, as much as everyone, like I said, everyone's used to that big fat book and flips to the last page, there's a lot of information in your audit report, and a lot of it's municipal specific. It's really important to really read those footnotes and see if that information is relative to you, and you'd be surprised how many questions we get or other footnotes that we could include that are related to your municipality that are maybe or maybe not being included.
Questions for the audience. As you know, I work with these wonderful women, and so two things that Valerie and Mon talked about were the whole opinion on the financial statements and GAAP versus, can you hear me?
Can you hear me?
GAAP versus GFOA, or regulatory basis, and I actually had a very small municipality over the last 2 years have a little bit of a conniption about the fact that they had, what do we call it, an exception as far as not reporting on GAAP. And so this little town said, well, then 500 municipalities in the state of New Jersey don't comply. Why is that? Well, that's because we have the basis in New Jersey that we have. And so this little town said to me, well, then we want to report GAAP. And I said, well, wait a minute. You're now reporting a net pension liability of millions and millions of dollars. So you really want to report GAAP and show that you have deficit and fund balance. So that put that a little bit in perspective. The other thing that they talked about was fixed assets. And as Val and Mon both mentioned, is that division comes up with things that are their key things. And so fixed assets are. Some of my municipalities have asked me, which appraisal company should I use? And I just caution you to do that, because in a town, you're looking at assets that cost over $5,000, and you can probably say you could count them on both of your hands in some of the towns. So you might want to talk to your auditor about the cost-effective way to do that, because you're accounting for land. That doesn't change greatly over the course of time. Buildings don't change greatly over the course of time. You can really track them in an Excel spreadsheet. And what they said is why they're unaudited is because if your municipal building was constructed or acquired back in 1900, nobody knows what the value of that building was or what the town paid for it. So we've said, you can get a current assessed value to market, to assess to equalize value to come up with a market value, and then discount it back to the year that the town acquired it. So there are ways to do it, and I highly suggest that land and buildings are controlled in an Excel spreadsheet by the CFO, and then depending on how much movable equipment you have. We know vehicles is a big ticket item, and again, in most towns, I think you can list all your vehicles within numbers, know when a vehicle goes out of use and when a new one comes on and is purchased. So it's really manageable and can eliminate this issue.
Hi.
Hi, how are you?
I wanted to follow up on your comment regarding GASB 75, that the
Yes.
state is going to be providing information by mid-November.
Mm-hmm.
What is the state providing? Because we
They-
haven't been able to get any clear answer as to who's responsible to
I
provide
would
this.
assume they will be issuing some of the similar report that they have issued for GASB 68 for pensions. Probably an actual report of some sort, and also a report detailing the liability of each of the towns or school districts in the state, all the entities, participating entities in the state, along with any deferred amounts they have, and contributions, plan description, everything that we would need basically for the notes.
Right.
So you have somebody from the state saying that they're providing that
They
too?
are providing it.
Okay.
They're actually, from what we've gotten from the state right now, is the actuary is still working on doing their valuation.
Their audit.
And at that point, the actuary's information will then be going to the state auditor, KPMG, who will then do their audit of the actuary's report. And at that point, once their audit is complete, then they will release the data to us. And so we're still in limbo at this point, as we're not even sure what information they're going to really give us, as we have no idea what KPMG is going to release in their report. So we feel like we're sort of chasing our tail for a standard that really is applicable, and we've known about it for several years. It was similar with GASB 68, that when they released the pension information, it was a very long delay giving us that information. So I know we're all sitting waiting to see what information will be included in that report.
So are any of your clients hiring their own actuaries, or is everybody just waiting to see what we get from the state?
Correct. Everyone is waiting to see what they're getting from the state, and at that point, when we see what type of information we receive and in what format by municipality, is when we then, as the auditors, have to sit down and look at, well, what audit procedures do we need to apply now to this report on some statistical information or included covered payrolls or whatever is being covered. Is that number actually related to those municipalities? So it feels like we're chasing our tail a little bit, and I apologize, but the state's slow on this one.
Your comment brings up a good point, too. There are municipalities out there that provide their own post-retirement benefits. So other than health benefits, so if you are one of those municipalities or county that do have it and do get what they call the GASB 45 report every other year or every 3 years, then you are also affected by GASB 75, and you have to talk to your actuary as to how to comply with GASB 75.
Because a lot of times we've seen where your own liability, which you have been getting an actuary's report, and you're in your 3-year cycle, and last year you got a new report because that was your year of the 3rd year, you now have to get yet another report this year under 75, which we've seen, and especially those that are in the health insurance fund. There was a couple of health insurance funds, and if you offer the lifetime health benefits under those health insurance funds, there's an actuary's report that needs to come from those insurance funds additionally. So we have to make sure that those reports are being done under GASB 75, not under the reporting model of 45, which they currently are already being done.
And we've seen that with GASB 68, the liability calculation that they come up with, if you compare the last 3 years, there was a huge jump in the 2nd year, and then this year, when we're doing our school board's audit right now, there was not a huge drop, kind of similar back to the numbers in the 2 years ago. So from our end as auditors, we don't have the expertise to really evaluate, well, do these numbers make sense? How can they change by millions and millions of dollars from one year to the other? But when there's so many factors that go into that calculation in terms of mortality, what kind of discount rates they're using, that any slight changes in those numbers, it's a huge
swing. Yeah, we saw the first year we had our numbers. The 2nd year we saw about a 15% increase in everybody's liability, and right now we're seeing about a 20% decrease. So over a 3-year period, we've gone up and come back down again. So it makes you wonder on these calculations that they're doing. But I do know that they did, based on reading that report for the 68 information, they changed mortality rates. And when they changed the mortality rates, the liability spread out over a longer period of time. Therefore, it came down. So, like we said, when we see 75, it'll be a whole new ballgame of what numbers are included and what assumptions they made on those reportings.